What if I told you the silver price flashing on your screen right now is a lie? Not a mistake, not a glitch, a calculated illusion, and the proof is sitting in a vault report almost nobody reads. Stay with me for the next few minutes, because what you're about to discover will completely change how you see precious metals forever. Here's what happened on a single trading day that broke everything we thought we knew about silver. 3 different prices for the same metal at the exact same moment. Silver spot climbing to $84.11, flashing green and moving higher. SLV, the world's largest silver ETF, bleeding red at $76.16. COMEX Silver Futures also red, sitting at $83.77. Think about that for a second. One asset, 3 completely different signals. That's not normal market behavior. That's not just volatility. That's a symptom of something most investors never see coming. Something happening beneath the surface that the financial media is almost entirely ignoring. And if you own silver, physical, paper, or anything in between, you need to understand what's actually causing it, because this isn't just about price movement, it's about what's real and what's just a promise written on paper. Before we go further, drop a comment and tell me the exact date you're watching this. I love knowing when you're tuning in. And if you value research that goes deeper than headlines, hit subscribe and type Henry's Market HQ below. It genuinely helps this content reach people who need to see it. Now let's start with something most people get wrong from day one. They think the spot price of silver is the real price. It's not. That number you see quoted everywhere, on financial news, on trading apps, on every investment website, is derived from the COMEX, which is a futures exchange operated by the CME Group, where institutional players, mining companies, banks, and hedge funds trade contracts. Not silver, contracts. These are legal agreements to buy or sell a specific quantity of silver at a specific price on some future date. But here's the kicker that changes everything. The vast majority of these contracts never settle in actual metal. They're cash settled, rolled over, or closed out before delivery ever becomes a reality. So the price the entire world watches, the price that drives investment decisions worth billions of dollars, is being set by a market that barely touches physical silver. For decades, this worked fine. The gap between paper and physical stayed manageable, stayed within acceptable bounds, and nobody really questioned it. But something has shifted, and the warning signs are flashing in a document most retail investors have never even heard of. Every single day, the CME publishes something called the Silver Stocks Report, and it's a vault-by-vault breakdown of how much silver is actually sitting in COMEX-approved depositories across the United States. And it splits that silver into 2 critical categories: registered and eligible. Registered silver is metal that's been specifically earmarked and approved for delivery against a futures contract. It's committed, it's pledged, it's ready to go. Eligible silver, on the other hand, is just stored there. It could potentially be registered, but it hasn't been committed yet. It's sitting in limbo, and it can walk out the door at any moment. As of the most recent report, total COMEX silver inventory stood at approximately 344 million ounces. Now, on the surface, that sounds like a lot, right? A massive stockpile. But here's where the problem begins, and it's a problem that's getting worse by the day. Only 78.6 million ounces of that total is registered. Do the math. That's less than 23% of the total inventory actually available for delivery against the contracts being traded on the exchange. The other 77%? It's just sitting there, uncommitted, unallocated, and in some cases, disappearing entirely. And this is where it gets really interesting, where the data starts telling a story that almost nobody is paying attention to. On a single trading day, over 1 million ounces of eligible silver walked out of one vault, one depository. Just gone, removed from the system. Not moved to registered status, not committed to delivery, not transferred to another COMEX facility, just removed entirely from the COMEX complex. The net result across all vaults? A reduction of 216,977 ounces in just 24 hours. Silver is leaving the system faster than it's being replaced, and the registered inventory that actually backs these futures contracts is getting thinner and thinner. This is not some conspiracy theory. This is not speculation. This is publicly available data published by the CME every single day, and almost nobody is talking about it. Now here's where this situation gets even stranger, even more disconnected from what traditional market theory would predict. On that same day, the US dollar index, the DXY, which measures the strength of the dollar against a basket of foreign currencies, was trading at 100.025, and it was green, meaning the dollar was strengthening. Meanwhile, at the exact same time, gold and silver were also climbing. If you've studied markets for even 5 minutes, if you've read even the most basic economics textbook, you know that's not supposed to happen. When the dollar strengthens, commodities priced in dollars usually fall because they become more expensive for foreign buyers, demand softens, and prices drop. That's Economics 101. That's the fundamental relationship everyone learns. But when the dollar and precious metals both rally together, when they both move up at the same time, that's something entirely different. That's a safe haven stampede. It means institutional money, the smart money, the money that moves markets, isn't buying gold and silver because the dollar is weak. They're buying because something deeper, something structural, something they're seeing in the data is making them nervous. And that kind of fear, that kind of defensive positioning, doesn't reverse overnight. It doesn't disappear with a single good jobs report or a Federal Reserve statement. Now add this piece to the puzzle, and the picture becomes even clearer. Retail investors, ordinary people like you and me, were net selling silver exposure on that day. They were reducing their positions, they were getting out, they were taking profits or cutting losses. Yet despite all that selling pressure, the price kept climbing. When ordinary investors are dumping and the price still rises, it tells you one thing with absolute clarity. Bigger, smarter, more sophisticated money is quietly absorbing everything retail is selling, and they're doing it for a very specific reason. They're positioning for something. They see something in the data, something in the fundamentals, something in those vault reports that retail investors aren't even looking at. If this is starting to click, if this is making sense, go ahead and smash that like button. It genuinely helps this channel reach more people just like you. Now let's be completely honest here, because you deserve the full picture, not just the bullish narrative. There is a bearish case for silver, and ignoring it would be intellectually lazy and dishonest. So let's walk through it with the same rigor. First, industrial demand. About half of annual silver demand comes from industrial applications: solar panels, electronics, medical equipment, electric vehicles, 5G infrastructure. And if the global economy slows down, if manufacturing contracts, if we enter a recession, that industrial demand floor can soften significantly. That's a real risk, and it's one that anyone holding silver needs to account for. Second, monetary policy. If the Federal Reserve signals a return to tighter monetary policy, if they pivot back to aggressive rate hikes to fight inflation, or if risk appetite in broader markets collapses and investors flee back to cash or government bonds, then the money that moved into precious metals as a hedge might rotate out, creating selling pressure that pushes prices lower despite supply concerns. Third, a strong dollar rally. Not the mild green session we saw at 100.025, but a genuine, sustained dollar strengthening cycle could suppress silver prices in nominal terms, even if physical demand remains firm and even if the supply situation continues deteriorating. These are real risks. These are legitimate concerns, and anyone managing serious money in the silver space has to hold them honestly and plan for them. The mistake, the critical error that most people make, is letting those risks become the only lens through which they view the market. Because while the bearish risks are speculative and forward-looking, the physical supply story is not speculative at all. It's documented, it's measurable, it's published daily in official exchange reports, and it's telling a very different story. For years, the gap between paper prices and the true cost of acquiring physical silver in size has been dismissed as a technicality, as a quirk of the market, as something only the hardcore gold bugs and doomsday preppers worried about. But that gap has a breaking point, and we may be approaching it faster than most people realize. It's called a delivery squeeze, and it's one of the most violent and disruptive events that can happen in a commodity market. A delivery squeeze happens when enough futures contract holders simultaneously demand physical delivery of the metal they've purchased on paper, and the registered inventory available on the exchange cannot satisfy those demands without emergency measures. When that happens, when the system is put to the test, there are only 3 options available. Option 1. Emergency procurement of eligible metal, convincing holders of eligible silver to convert it to registered status, which may require price incentives. Option 2. buying additional metal from the open market at whatever elevated prices are necessary to fulfill delivery obligations. Or option 3, cash settlement at prices significantly above the paper quote, essentially paying off contract holders in dollars instead of metal and admitting that the physical delivery promise cannot be honored. Right now, today, as you're watching this video, registered inventory is sitting at less than 23% of total COMEX holdings. That is not a comfortable buffer. That is not a healthy margin of safety. That's a razor-thin cushion operating under a system that was designed for a world where almost nobody ever actually asked for the physical metal, where almost everyone just rolled their contracts forward or settled in cash. But what happens when that changes? What happens when that 1 million ounces that walked out of the vault doesn't come back? What happens when eligible becomes unavailable? When the 77% that's sitting uncommitted starts disappearing faster? When registered inventory drops to 20%, then 15%, then 10%? The answer is simple, and it's happened in other commodity markets before. The paper price and the physical price violently reconnect. The fiction meets reality, and the people holding paper promises find out very quickly what they actually own. Let's talk about SLV for a second, because this is important for millions of retail investors. SLV is the largest silver ETF in the world, and millions of people hold it in their portfolios thinking it's a clean, direct, reliable proxy for silver prices. But on the day we've been dissecting, SLV was trading at $76.16, while spot silver was quoted at $84.11. That's not a rounding error. That's not a temporary glitch. That's an $8 spread on what's supposed to be the same underlying asset. SLV is supposed to hold physical silver bars in custodial vaults, primarily through HSBC and other major banks. And when you buy shares of SLV, you're supposed to be getting exposure to physical silver. But when the ETF trades at a massive discount to spot, it signals one of 3 things, and none of them are good. Either creation basket mechanics are breaking down and authorized participants are having trouble bringing new silver into the fund, or redemption pressure is spiking and people are trying to get out faster than the fund can liquidate metal, or the market is pricing in serious doubt about SLV's ability to acquire physical metal at spot prices when it actually matters. For the average retail investor, that divergence should be a flashing red alarm, a warning signal that the thing you think tracks silver might not actually track silver when market stress appears, when you need it most. So where does all of this leave you, the person watching this video, trying to make a smart, grounded, informed decision about precious metals in a market that's sending contradictory signals from every direction? It leaves you right here, better informed than 99% of people who think they understand silver. You now know the difference between what's real and what's a claim. You know that the spot price is largely a fiction written by a paper market that rarely settles in metal. You know that registered inventory is shrinking. You know that when spot, SLV, and futures all tell different stories on the same day, the system is under stress. And you know that stress doesn't resolve slowly, doesn't fade away gradually. It resolves suddenly, violently, and often in ways that catch almost everyone by surprise. Here's what you can do today, right now, to position yourself intelligently. First, understand what you actually own. Paper is not metal. Exposure is not possession. If your entire silver allocation is in ETFs, futures, or mining stocks, you have exposure to silver's price movements, but you do not have silver. And that distinction becomes critically important in stress conditions. Second, read the CME Silver Stocks Report regularly. It's free, it's published every single day, and it takes about 3 minutes to read the key numbers: total registered, total eligible, net change, and vault-by-vault movement. The investors who track this data consistently are operating with a layer of information that simply does not show up in price charts or financial news headlines. Third, treat divergence as a monitoring signal, not a trading signal. When the 3 main silver instruments are telling meaningfully different stories about the same metal on the same day, it's a sign that the system is under some form of stress, and that stress deserves your attention. This video isn't here to sell you anything. It's not sponsored by a dealer or a fund or a mining company. It's here because this information fundamentally changed the way I think about money, and I believe it should do the same for you. The silver market is entering a phase where the gap between paper claims and physical reality is becoming impossible to ignore. Watch the registered inventory. Watch the vault flows. Watch what happens when that 23% becomes 20%, then 15%, then less. That number is the one almost nobody is watching closely enough, but now you are. If this video added real value, subscribe and hit the bell so you don't miss what's coming next. Leave a comment with your biggest takeaway or tell me, are you holding physical, paper, or both? I read every single one. And if you want to go deeper into this topic, check out the video on screen now. It connects directly to what we just covered. Thanks for watching, stay sharp, stay informed, and I'll see you in the next one.